Michael's first idea is BCE, which is the parent of this network.
Yes, and I think that BCE is a really attractive investment in the current environment that we find ourselves in. They've had huge capital outlays over the last dozen years or so, putting fiber to the home, and that is beginning to wind down a little bit. They currently cover, I think, over half of their potential area. And over the next few years, that could be as high as 80%. They're doing very well, so we expect that we may see a little bit lesser pressure on their capex over the next few years. They have an extremely attractive dividend of 5.6%, around that area at current prices, and they have a history of annually increasing dividends. So I think in terms of a stock to own in a period of the sort of uncertainty we're facing today, BCE is a good place to position yourself.
As you say, a yield of 5.6%, and BCE is the owner of BNN Bloomberg through its ownership of CTV. Okay, your next idea, TC Energy, the pipeline giant.
Yeah, a couple of months ago I recommended Enbridge, and we like TransCanada as well. I mean, TransCanada usually sells at a bit of a premium to Enbridge, and certainly Enbridge today has a little bit higher yield than TC Energy, but we like both companies. And talk about your focus on natural gas, liquids pipelines, energy, power generation. It's well positioned there. Throughout their history, they've had a fairly solid history of annual dividend increases. And again, with the yield around 5.5% today, we think that it's a very, very good place to position yourself in. They've got a pretty strong balance sheet. They've recently raised some money. They did a $1.8 billion issue that further strengthened the balance sheet, and that puts them in a good position to fund future capital projects. They're talking about a $4.5 billion project in Mexico. So I think that TransCanada and Enbridge would be two positions we'd be looking seriously at today.
Mainly on the yield?
No, not just on the yield, but I think on the stability of their revenues too. I mean, they are highly contractual revenues, which I think is very, very attractive today.
Okay, and then your final idea is CAE, obviously linked to the ups and downs of the aviation industry.
Yeah, but I think CAE is a little bit more unique relative to an airline. I mean, they are in the service business to the airline industry on both the commercial and the defense side, and in their latest quarter, the stock got quite a kick after some disappointing news on the defense side, primarily in two large contracts, as I understand. One of them was a legacy CAE project, and the other one was a result of the L3 acquisition that they made last year. So I think that provides a real opportunity to invest in, one of Canada's star companies, really. I mean, in terms of a technology company, they are a leader in their field. We just saw over the last couple of days a 15-year contract with Qantas Airlines. To date, Qantas has done all of their own training for pilots. Mm-hmm. Now they're going to trust CAE to do that. I think that could incrementally be, somewhere. I've seen estimates between $30 and $40 million a year in revenues. Training, existing and new pilots, about 4,500 a year, roughly speaking. So I think that CAE right now, as one of Canada's stalwart companies, has got great potential for capital appreciation over the next few years.
The stock down about 17% this year. They did just take charges on two of their defense programs. So it's capital intensive, this business.
Right. Oh, very much so. On the defense side, let's face it, the contracts there are pretty tight margin contracts, and some of them are, almost at fixed price kind of rates. And so when you see some inflationary pressure on the cost side, it's not surprising to see that. On the commercial side, I think the contracts are a little bit more flexible. I think it's a rare opportunity to see, to be able to buy CAE, at the levels that we see it at today.